system, new technology, has done plenty of good for Americans. The ATM gave people easier access to their money, their own money. The internet simplified bill paying, gave people new ways to access credit and save for the future. The smartphone allows people to check their bank balance anywhere at any time. But of course, technology has done plenty of harm too. Automation allowed high-frequency trading that created the flash crash and contributed to the '08 financial crisis. Automation allows consumers to send instant payments to each other through peer-to-peer payment platforms, but it also allows consumers to be defrauded and scammed out of millions of dollars on these platforms. Just this spring, social media fueled a bank run that crashed Silicon Valley Bank, the second largest bank failure in history. Of course, there are other elements to that. Artificial intelligence could cause even bigger changes in our financial system. We can't sleepwalk into a major transformation of our economy and put Americans' money and financial futures at risk. Increasingly, banks and brokers and insurance companies are allowing AI to process data, decide who can get a loan, tailor financial products to customers. With the advent of this new and potentially transformative technology, we have a responsibility to assess what AI means, not just for our financial system, but overall for the American people. AI is a tool. We have the responsibility to set policies to ensure that when and if this tool is used, it's used to make our economy work better for consumers and savers, not to exploit them. This committee will begin to examine current and future applications of AI today in our financial system. We'll discuss how we can ensure that AI doesn't just become another way for Wall Street and Silicon Valley to supercharge existing tools to rig the system for their benefit. In an ideal world, new technologies can make us better off by increasing productivity and making goods and services more affordable and accessible. Unfortunately, as history has shown many times, the benefits of technology are often overhyped, while the downsides do real damage to people's lives and to society as a whole. The ones doing the overhyping are generally big corporations. For example, the companies that mentioned AI over 1,000 times during the quarterly earnings calls in April and May, over 1,000 times. Those companies stand to make a lot of money off the so-called efficiency that new technology brings. Of course, we all know, and this committee mostly should understand or does understand, Wall Street's version of efficiency usually means lower wages, fewer jobs, and less economic security for workers, and much higher profits for corporate America, and particularly in billions of dollars for a select few. Go to Toledo, Ohio, visit the picket line at the Jeep plant. Talk to the workers I spoke with over the weekend. The CEO of Stellantis makes 365 times what the average worker makes. 365 times what the average worker makes. Workers have been the casualties of an inevitable march towards progress too many times before. And anyone who dares to question it gets mocked and gets called a Luddite. With the emergence of AI, we have a responsibility to ensure this technology is used, when it's used at all, to protect consumers and savers while promoting a fair and transparent economy that works for middle-class Americans rather than taking advantage of them. At a minimum, the rules that apply to the rest of our financial system should apply to these new technologies. We need to make sure that our existing laws are used to protect consumers, and if emerging technologies aren't covered by existing rules, then we must pass new ones to create real guardrails. Companies are already using AI in their financial system. Banks use algorithms and machine learning to make credit underwriting decisions and to allocate people's investments. They automate trading. Proponents claim they are making our financial system fairer and less expensive, making financial services more accessible, and of course, making it all, here's this word again, more efficient. But efficient for whom? Algorithmic trading has evolved over decades with bigger and more powerful computers processing billions of bytes of stock market data. It's made a lot of people in Wall Street a lot of money, but it's not clear it's done anything for our economy other than speed up the financialization that has already done so much harm to American workers. We've already had to put in place guardrails like stock market circuit breakers to prevent electronic trading programs from crashing our markets. Without guardrails, without consumer protections, AI would be just a new tool for Wall Street and Silicon Valley to swindle Americans out of their savings, to trap them in debt, to strip them of their financial security. Have we not seen that before? And while some uses for AI, automated credit, underwriting, algorithmic trading, have been in practice for years, what's known as generative AI is creating new ways to remove human decision-making from financial services. These so-called advances make it harder to determine who is accountable when things go wrong. Look at what's happening in consumer lending markets, where AI models used to determine borrowers' creditworthiness too often automate and supercharge biases that exclude Black and Latino Americans. It's hard to eradicate discrimination when even the developers can't really explain how the models get to the decisions they make. Instead of removing human biases from consumer lending markets, AI data models essentially bake the worst ills of our past into the cake, and then they disguise it as impartiality. Discrimination is discrimination, regardless of whether it comes from a human being or from a machine created by human beings. Meanwhile, fraudsters use cyber attacks and so-called deep fake AI technologies to deceive American savers. I recently wrote to several banks and the Consumer Financial Protection Bureau about what steps they're taking to address the alarming rise in deep fakes to fool voice authentication security system and scam consumers. We have laws to deal with fraud, and those laws will be enforced whether it's a human or a machine defrauding Americans, but we need to go further to protect Americans. We can't make these technologies safe for consumers and savers without being honest with ourselves about their limitations. With the wide availability and growing adoption of AI, we also must be wary of unleashing untested technology into widespread public use. Consumers should expect, Congress should require rigorous testing and evaluation of AI models and programs before they are used in the real world, determining whether they can cause real harm. None of this is to say, of course, that AI has no place in the economy, but Americans have every right to be skeptical, particularly when it comes to their finances. We must assure that innovation's benefits flow to all Americans, not as far too typical just a handful of Silicon Valley billionaires and Wall Street executives. We've seen it far too many times. I think one thing my colleagues and I agree on is the Silicon Valley ethos of move fast and break things is dangerous for both our financial system and our entire economy. I look forward to working with my colleagues to ensure that we end up with AI technology that is well tested, that protects privacy, preserves civil rights and consumer protections. And finally, I'd like to thank Senator Rounds for his efforts, and they've been many, to help the entire Senate better understand the challenges and opportunities proposed by AI. Senator Rounds.
Thank you, Chairman Brown, and thank you to our witnesses for being here today to discuss what I believe to be an extremely important topic. And on a bipartisan basis, the entire Senate is trying to learn more about this very important topic, and I've appreciated being a part of it, but it has been a team effort. I also want to thank Ranking Member Scott for giving me the opportunity to fill his large shoes today. We stand in the middle of a journey of monumental change. While artificial intelligence, or AI, has been around in various forms for years, recent advances in the most cutting-edge models have shown us just how capable the technology has become. The financial services industry has already been effectively utilizing AI for decades, just under a different name. Whether it's algorithms, modeling, predictive analytics, or data management, the industry has been using AI and other emerging technologies to utilize data and improve the customer experience. Take fraud prevention just as one example. Despite the billions spent to protect institutions and the billions paid to buy off attackers, things are only getting worse, with synthetic identity fraud costing banks nearly $50 billion last year. As many as 95% of phony identities go undetected. Traditional methods of fraud detection rely on manual verification and human analysis, which unfortunately have failed to keep up with more sophisticated fraud schemes. By using AI and machine learning, companies can analyze relationships between entities, identify suspicious patterns, and visualize intricate connections, revolutionizing fraud detection and investigations. This allows for a more proactive approach where AI is used to prevent fraud before it happens, as opposed to the traditional reactive approach to fraud detection. Machine learning and AI have also opened the door to accurate forecasting and prediction. While a number of industries are asking for regulation, the financial services industry is uniquely poised to adapt to emerging technology. In a large number of instances, financial regulation is already technology neutral and outcome-based. If a lender uses AI to determine creditworthiness by harnessing data to predict the probability of default, any technology needs to be compliant and fair lending focused. That said, transparency and explainability in decision-making, especially where credit is involved, are important areas where Congress may play a role. Lending algorithms can't simply exist in a black box, and human control is necessary. AI is data dependent. The technology is only as useful as the quality of data that goes into its models. The finance sector is one of the few industries that has been collecting, storing, and protecting verified data for decades, making its models some of the most useful. Therefore, it is imperative that we continue to invest in cyber infrastructure to protect these databases. It's critical that we understand how bad actors could abuse AI technology to disrupt our financial system. However, we must always remember that what was illegal before AI remains illegal, and individuals abusing technology to carry out illicit activities should and will be prosecuted to the fullest extent of the law. I believe Chairman Brown mentioned the same thing in his opening statement. That brings me to the role Congress will play in the regulation of AI. Moving forward, I think it is important that we take a pro-innovative stance, which will allow the United States to keep and attract the best and brightest talent. Although we will have many discussions about the dangers, we must also acknowledge that halting progress can be dangerous, especially as our global competitors, such as China, have no intentions of slowing down. Financial regulators should allow Congress to act and resist the urge to overregulate new technology as they run the risk of unintended consequences. We are already seeing this take place in the proposals like the Predictive Data Analytics Rule published by the SEC. In this attempt to control emerging technology, the proposal would cause current successful uses of the technology to suffer. The U.S. continues to be the birthplace of new innovation in this field. Congress should help shepherd the development of American AI, artificial intelligence that is embodied with key principles to promote confidence and trust, principles which include a right to privacy and transparency. We are at a crossroads. Artificial intelligence is real, and it's not going away. We have the opportunity to shape it in a way that reflects the values that are important to us. AI is a tool, and it's up to us whether we harness it to make improvements to our financial system or if we simply fall behind. Thank you, Mr. Chairman.
Thank you, Senator Rounds. I'll introduce the three witnesses. Melissa Coide is Director and CEO of FinReg Lab, a nonprofit that tests new technologies and data in the financial marketplace. Prior to FinReg Lab, she served as U.S. Treasury Department's Deputy Assistant Secretary for Consumer Policy. Welcome. Professor Michael Wellman's Professor, Division Chair of Computer Science and Engineering at the University of Michigan. His research is focused on computational market mechanisms and game theoretic reasoning methods with applications in electronic commerce, finance, and cybersecurity. Welcome. Daniel Gorfine is the founder and CEO of Gattaca Horizons, currently serves as adjunct professor of law at Georgetown Law Center, teaching fintech law and policy, previously appointed to serve as the Commodities Future Trading Commission's first chief innovative officer and director of Lab CFTC during the Trump administration. Ms. Coide, please proceed.
Thank you very much, Chairman Brown. It's a pleasure to be here this morning. I am the CEO and founder of FinReg Lab. We are a nonprofit research organization that has been conducting research looking at data and technology and the potential implications for public policy, market practices, and financial inclusion. FinReg Lab has been working on machine learning and artificial intelligence in financial services since 2019, focusing specifically on machine learning models and data in credit underwriting. Although interest in machine learning AI topics has clearly skyrocketed with the advent of ChatGPT, it is early days and the financial sector has used various forms, as you point out, of statistical analyses and automation for decades. My testimony is going to start by addressing the adoption of machine learning in credit underwriting, given it is an application with high risk, but also the potential for high reward opportunities as we think about the 50 million U.S. adults in the U.S., as well as the millions of small businesses who cannot be sufficiently credit risk assessed with more traditional methods of underwriting and the data that are typically used. Questions about using machine learning in credit underwriting, however, anchor, as you all point out, around the legal requirements on lenders to communicate when credit decisions are made, the factors that drove a credit decision, denial of credit access, pricing of a credit decision, as well as legal requirements around evaluating for disparities and the important safety and soundness expectations that models are safe, sound, and robust. To examine these issues, FinReg Lab evaluated proprietary and open source machine learning tools used to perform tasks relating to model risk management, adverse action notice generation, and fair lending compliance. Our research, in short, found certain techniques were able to generate reliable explanations as to which features were most important for the model's predictions, even for more complex machine learning algorithms. There was, however, no one-size-fits-all approach or technique, and overall, it really depended upon the human oversight, engagement, and understanding of the models and the data choices that were being used to train those models. We also found machine learning has the potential to improve fairness and inclusion. Machine learning automated approaches produced a range of alternative model options with smaller demographic disparities than more traditional methods for fair lending analysis. We are encouraged by the interest in machine learning techniques, both by banks, non-banks, as well as consumer advocates and regulators. As for generative AI, while it is still very early days, it is obviously attracting considerable interest and investment. However, financial services providers are taking a cautious approach, specifically with internal testing of internal report generation as well as code generation. Customer-facing use cases are especially high risk due to the potential for Gen AI models to provide inaccurate information, discriminatory or otherwise harmful outputs, and expose sensitive information. Regulatory compliance demands a level of explainability and transparency, which you both referred to, that many providers are not confident they can attain at this point with Gen AI applications. To that end, federal regulatory frameworks and laws play a foundational role in how financial firms are approaching the testing, development, and use of models. In fact, the legal requirements and governance expectations apply regardless of the technology underneath the models being deployed. While use cases of AI are still very early days, several actions taken from actors, importantly across the financial services ecosystem, from the advocates to the market actors themselves to researchers, would benefit and help all of us move forward towards best practices and safeguards in the use of AI and machine learning in financial services generally. First, a review of risk management and customer protection frameworks that apply to automated decision-making. Model risk management expectations and fair lending requirements do not apply equally to actors across the financial ecosystem, and some stakeholders have pointed out that imposing basic governance expectations on non-bank financial providers could be beneficial to the broader ecosystem. Second, an articulation of frameworks to govern AI. What is good in AI when we're deploying it in financial services? Consistent with high-level principles or standards could be valuable at this stage, aiming all the financial actors moving in the same direction as they're thinking about using more simple or more complex AI techniques. Third, careful consideration of data governance practices, standards, and policies would be helpful. While federal laws provide more detailed and robust protections for consumer financial data than other types of consumer data, key laws like the Gramm-Leach-Bliley Act are old, 20 years, and we haven't updated them. Finally, Congress could dedicate resources to support public research in these areas and ensure engagement by historically underrepresented and under-resourced actors in the financial ecosystem. We're all going to have to learn and keep up with how this technology works. We all have an important role to play in making sure that the evolution of our laws and our market practices are for the good and the benefit of consumers, households, and the broader financial system. So the education and the research is critical for all of us getting there. Thank you very much.
Professor Gorfine.
Thank you, Committee Chair Brown, Senator Rounds, and members of the committee for the opportunity to testify before you today. I'm the founder and CEO of Gattaca Horizons, an adjunct professor at Georgetown University Law Center, and former Chief Innovation Officer and Director of Lab CFTC at the U.S. Commodity Futures Trading Commission. My testimony presented here today reflects my personal views. The topic of today's discussion has gained renewed interest given recent AI-related advancements. It is an area of fierce global competition where the U.S. holds many competitive and first-mover advantages, and an area that should be responsibly fostered through thoughtful policy approaches. I commend the committee for engaging on this topic and support deliberative efforts to understand the role of AI in financial services, existing legal and regulatory frameworks, and potential policy approaches that can foster the tremendous opportunity presented while mitigating risks. To level set, AI in financial services is not new, and instead is part of a steady progression of using computers and advanced analytics to increase automation in the sector since the 1980s. Over the decades, AI-related technologies have continued to develop, as have financial services applications. Most recently, we have witnessed the public rollout of large language models and a subset of LLMs known as generative AI. AI applications in financial services have already yielded benefits to consumers, small businesses, market participants, and regulators through greater efficiencies, enhanced insights, expanded access, and lower costs. As with any area of innovation, however, there are important risks associated with AI, including the potential for perpetuating bias, infringing on data privacy and IP, failing to operate as expected, and advancing frauds and scams. The mere speculative fear or fear of future harm, however, should not broadly block development of AI in financial services, including by those small firms and community banks seeking to remain competitive in an increasingly digital economy. To this end, as a key guiding principle, I would encourage the committee and regulators to assess new AI-based models on their ability to improve off of a highly imperfect status quo. This principle should apply across AI applications, since a singular focus on risk can blind us to greater benefits as compared to legacy approaches. As noted, financial services regulations have long governed the adoption of emerging technologies in this sector, whether through rules to ensure consumer protection and investor protection, or principles-based model risk management to ensure safety and soundness. These frameworks apply to conduct and activities regardless of the technological tools used by the regulated entity, and they're capable of identifying and mitigating risks while fostering innovation. That said, this discussion also makes clear that, as with any area of technological advancement, we will need to evolve how we apply governing frameworks. The following are recommendations that can help to achieve balance in this effort. First, encourage innovation, but monitor for novel risks. It is important that policymakers use their soft power to encourage ongoing measured and compliant innovation, especially with respect to small firms and community banks. Second, enhance clarity and consistency within existing risk management and activity-specific guidance. Regulators should also encourage and help foster the development of standards, including through collaboration, recognition of standard-setting organizations, and the use of safe harbors and guidance that explicitly encourage adherence to such standards. Third, modernize a federal data privacy framework. Given the centrality of data in AI, it is imperative that Congress work to establish a national framework that governs data privacy, advances cybersecurity, and ensures that consumers have control over how their data and information is being used. Fourth, avoid hasty and speculative regulation that can chill innovation. Given existing regulation, it is important for policymakers and regulators to avoid hasty and prescriptive rules based on speculative or hypothetical future risks that have not yet emerged. Only once actual risks have been identified should targeted policy or regulatory interventions be considered. Fifth, monitor broader Gen AI developments and discussions to inform financial regulation. Some of those broader discussions may benefit by looking to and incorporating existing risk management frameworks common in financial services. And those broader discussions should also inform financial services regulation, but not create unnecessary duplication, conflicts, or ambiguity. Finally, prioritize law enforcement, collaboration, and new technologies to combat fraud and scams. It is appropriate that law enforcement agencies take the lead in investigating and prosecuting illegal activity. It is further necessary that these agencies work collaboratively with the private sector and regulators to ensure the sharing of information and best practices, increased tech literacy, and the adoption of advanced tools to combat threats. Thank you for inviting me to speak with you today. AI is a technology that will be at the center of the remainder of the 21st century. It is a technology where the U.S. must lead in a world of increasing competition, and I'm happy to answer any questions that you may have.
Thank you, Professor Wellman.
Chair Brown, Senator Rounds, distinguished members of the committee, it is a privilege to testify before you today. My name is Michael Wellman, and I am Chair of Computer Science and Engineering at the University of Michigan. I earned my PhD in artificial intelligence from MIT in 1988 and have worked as an AI researcher ever since. For the past dozen years or so, my research has focused on understanding the implications of AI for financial markets and the financial system. All opinions expressed in this testimony are my own. It seems everyone is exercised these days about rapid advances in artificial intelligence. AI promises extraordinary benefits, expanding knowledge, automating onerous tasks, and making valuable services accessible and affordable to broad segments of our society. AI also poses risks to security from malicious exploitation of AI, to safety from inadvertent AI behaviors, and of disrupting how we work. Promises and risks of AI pervade every area of our economy and society, including quite distinctly the financial sector. Of course, the future path of AI is highly uncertain. If somebody tells you they know where AI technology will be in 5 years or 10 years, or even next year, don't believe them. AI has surprised us many times, including within the past year by the stunning performance of ChatGPT. It is likely to keep surprising us. In financial markets, AI is already widely employed, a situation that has developed largely under the radar. Gauging the exact extent of AI in algorithmic trading today is not possible for lack of public information. Trading firms do not publish their strategies and methods for obvious proprietary reasons. This opacity is itself a source of risk. There is a keen public interest in understanding how trading practices affect market fairness, efficiency, and stability. The question is not whether algorithmic trading is beneficial or harmful. We must tease apart which practices and circumstances help versus hurt, and identify market designs or regulations that promote the beneficial and deter the harmful practices. For example, consider latency arbitrage, leveraging minuscule advantages in response time, milliseconds or microseconds, to extract profits from trades that would have happened anyway. We and others have advocated for thwarting this with a mechanism called frequent batch auctions, where markets clear at fixed intervals, perhaps every half second, rather than continuously, improving both fairness and efficiency. Now to some newer issues posed by the latest AI developments. The first is market manipulation. This is an old problem, but AI manipulators could make it worse. We can tackle it by likewise exploiting AI for enhanced surveillance. This sets up what is called an adversarial learning situation, a kind of AI arms race between the regulator and the manipulator. An inherent feature of adversarial learning is that any advance in detection technology can be exploited by the manipulator to evade better. Where this leads in any given situation is an open question. It is also possible that AI-developed trading algorithms could produce manipulative strategies even if not instructed to. Our research has demonstrated automatic learning to manipulate a financial benchmark given only the objective of seeking profit. Are current regulations adequate to handle such a situation? Much of the existing law depends on intent to manipulate, and how that would apply to an AI that learned on its own is unclear. This is just one example of an AI loophole. Our existing laws, generally speaking, assume that people make the decisions. When AIs are deciders, Do our laws ensure accountability for those putting the AIs to work? The second issue relates to advances in language processing exhibited by systems like ChatGPT. Language understanding and generation opens up new channels for AI influence. Just as human manipulators employ social media in their pump and dump schemes, AI systems could inject misleading information. This brings us back to market manipulation, which is really just a special case of the broader problem of misinformation and fraud. In the wrong hands, AI can be great technology for deploying scams. Finally, the new AI technology obtains its power through training over massive data sets. The concern is that only entities with access to the largest scale information can produce AI at the highest level. In financial trading, concentrations of information access and ownership could convey extraordinary advantages. How might trading on information aggregated at massive scale affect fairness and efficiency of our financial markets? These are a few ways that new AI technology could pose novel concerns for financial markets. AI also offers the potential to protect market integrity and level the investment playing field. Which outcome we get will be determined by how we reconsider market designs and governance mechanisms for the world of AI-powered trading. Thank you for the opportunity to present this perspective to the committee. I look forward to answering your questions.
Thank you. The question will begin with Senator Smith of Minnesota.
Thank you very much, Mr. Chair. I appreciate your generosity. And welcome to all of you. Thanks so much for being at the committee. It's a very, very interesting topic. Professor Wellman, I'd like to start with you. Last fall, the Consumer Financial Protection Bureau issued reports raising serious concerns about the increased use of automated tenant screening programs. And these programs are intended to help landlords determine how risky a prospective tenant is, maybe assigning them a score or even recommending whether the landlord should accept or deny that rental application. Of course, these determinations can be seriously flawed, just as the determinations that humans make could be seriously flawed. But in some cases, they've been found to rely on outdated or incomplete or just flat out wrong data, and others seem to be based on some of the same flawed assumptions and biases that have never been predictive of risk for tenants. So my question is, these AI models are complex, they're opaque. This is the black box problem that you were alluding to in your testimony. How can companies effectively assure landlords and prospective tenants that their rental screening programs are accurate and neutral? How can they make that assurance in this black box problem?
Thank you for the question. So as you point out, humans make mistakes and AIs will too. The danger, of course, is that when an AI can make a mistake, it can be deployed at large scale and,
right.
Systematically. Unfortunately, there is no general way to ensure the credibility of an AI-developed model. In principle, they could end up being better. But it really requires third-party scrutiny and,
yes.
and ways of validating and providing ultimately accountability, I think, is the ultimate solution, whether that is upfront through certification of the validity of the models or on the back end through auditability.
Is that a place where, as you are talking about, where we're looking at assigning, figuring out standards, is that a place where this concept of standards could come into play, establishing standards for these tools to assure that bias isn't creeping in?
Yes, I think that is a valuable role for government to take, is to establish standards, criteria for evaluation, and on a continual basis.
And I note that you talked about audits, sort of outside third-party audits. This is a topic, Chair Brown and Ranking Member Rounds, that came up in the AI summit that we had last week that I thought was very interesting. Ms. Coity, I hope I'm saying your name correctly, the allure of AI is that it has the capacity to learn without human intervention, and human intervention can be slow and expensive and even emotional. At least that's the theory, but as we've seen with early generative AI models, the technology isn't perfect. It's sometimes erratic, can be prone to error. And this may not be a big issue when people are chatting with bots, but it has a very high stakes when AI models are used in lending decisions, for example, or other applications that can have a big impact on a family's livelihood. So my question is, how can financial regulators effectively oversee and evaluate something that is as fast changing as AI? You touched on this in your testimony.
Sure. Thank you for the question. This is a really critical consideration, and it is why we spent 3 years looking at questions around what are the types of machine learning algorithms as a form of AI are being used in credit decisioning by banks and non-banks or fintechs, and the laws that we have in place that require lenders to tell a consumer why they got a certain credit decision denied or priced are actually factors that are affecting the choice of models that the financial sector is using. We are not seeing lenders, banks or non-banks at this point, to be fair, we haven't done a complete canvassing, moving into Gen AI for these credit underwriting decisions, but instead using supervised machine learning algorithms where there is human oversight. I do appreciate the bigger question of, as Gen AI advances, we are all asking the question, will it have applicability in things like credit decisioning? But those governance expectations, fair lending plus explainability, are critical and are affecting what models are being used by lenders, banks or non-banks.
Thank you. Thank you very much, Mr. Chair.
Senator Rounds from South Dakota is recognized.
Thank you, Mr. Chairman. First of all, thank you, all of you, for coming in today and being a part of this. Suitable talent is in high demand. JP Morgan said in May of 2023 that it has hired 900 data scientists, 600 machine learning engineers, and 200 AI researchers to execute its technology initiatives. I want to begin and just very quickly, because I've got a couple of questions, but just what are your thoughts? Can you just briefly give us a thought on what steps we need to take now to provide the AI workforce of tomorrow? Mr. Gorfine, I'll start with you.
Yeah, thank you for the question. And I'm a huge believer in education, and I think education into tech literacy needs to be happening at the earliest stages for a child. I'm a father of 3 daughters, and I'm a huge believer whether you move into the tech field or not, you need to at least understand the language. You need to understand what people are describing, because the reality is that technologies and machines are going to underpin all of the economic activity that takes place in our country and around the world. So we need to start early. I tell law students, take a computer science class, take a data science class, so you can also suss out what's real and what's not. So I think education and tech literacy is critical at the earliest levels. I think it's also critical in the government level and in the private sector. I encourage all senior leaders in government to make sure that you fully understand the language being spoken. And the same goes for business leaders in financial services. I think it's a risk if you don't know what technology underpins your operations. So education is really the answer, and sending a clear message that we're here to build and develop these technologies according to U.S. norms and values. And I think that's the way we outcompete on a global scale.
Ms. Cody, do you agree with that analysis?
I agree with that analysis, and I also think Mr. Gorfine is correct, starting early on. But I want to also recognize the challenges are in terms of what models get developed stem from the fact that there is human oversight of these models, and that we need diversity and different perspectives in the humans who are ultimately making the decisions about what data are we training the models on, what models are we deploying. And that means going all the way back to making sure that we have tech education happening, in our schools and in our communities across, looking even at, and I know there's been an effort to look at historically Black colleges and universities to make sure that we are bringing technology focus and education so that we really, in the end up with people working at JP Morgan Chase, or I'd like to think FinReg Lab, with real diversity and perspectives, with expertise.
Mr. Willman, anything to add to that?
What I'd add, as a chair of a computer science department, I'm proud that we're contributing quite a bit to the development of our tech workforce. And I think another strength that we've had in the United States is the ability to attract talent from around the world to come for advanced education and join our workforce.
Thank you. I think it's important to recognize that this technology has been effectively utilized for decades. The surge in advancement is prompting our discussion today. As we move to regulate AI, we have to avoid the unintended consequences of being overly broad. This is a question for all of you. How do we not screw it up? Mr. Gorfine?
Yeah, I think it's critically important to be principled in how we approach this space. So we have to recognize that we're starting from a base where there is a regulatory framework in place. Melissa and I were speaking, Ms. Cody and I were speaking about the fact that in financial services, there's the right scaffolding in place around regulation and governance. However, you need to monitor for where there are emerging risks, and once you identify specific risks, you tailor interventions to solve for those specific risks. Overbroad rulemakings will have unintended consequence. They'll capture activities that you're not intending to. They'll make it very difficult for small firms, for community banks to be able to adopt new technologies. So you don't want to be premature, preemptive. You want to make sure that it's reasoned and principled, and that's a balance that we have to strike.
Mr. Wellman?
Well, to be honest, I don't think we could prevent the advent of powerful AI in our economy if we really wanted to. That said, I think how regulation evolves will shape the economic development. I must disagree with my colleague respectfully that I think responding before the risk materializes is sometimes essential to avoiding really terrible outcomes. We can reasonably understand areas that pose risks and shape the environment so that we're more robust before they happen rather than wait until after it's too late.
Mr. Cody?
Yeah, I think the one thing I would add, I thought those were great comments, is just how important the data are that are actually being used in the models and the need to really focus on broadly how do we get consumer data privacy right, how do we think about updating our data privacy expectations in financial services. I say this often, the financial sector, the financial services offering is based on risk mitigation, which is based on data information. How are we striking that balance so that data are available to be used? We're making sure, importantly, that we're not leaving out marginalized communities because the data doesn't reflect an understanding of them, but also thinking about the data privacy needs and expectations. But the data piece is really critical.
Thank you. With the chairman's indulgence, very quickly, Mr. Gorfine, any other comment or correction or discussion in terms of the response from?
No, I think we're more like-minded when I say that this is a balance. It's more art than science of knowing when the right time for an intervention is. I identify data as well as a place where we need a national framework because that's clear. Risks around data, data control, data privacy, and use, especially in AI, are absolutely appropriate. We've also been able to identify this with high-frequency trading. We know the risks that exist. That was an area where there was awareness, this is over a decade ago, around new techniques, and it was absolutely right that more controls should have been put in place. So it is a balance. I think that the risk of going overbroad can send a message, and it stunts development, it stunts innovation, especially for small players who don't have the resources to figure out, is this going to work? Is this going to be compliant? Should I invest here or not if it's going to be blocked in the future?
And I am out of time, and I thank the chairman for his indulgence.
Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. I want to follow up on the preemptive nature of this issue. I worry that AI has the power to compound the existing problem of fraud in the financial system. According to the FTC, consumers reported losing nearly $9 billion to fraud in 2022, with more than a quarter of those losses coming from imposter scams. So, Ms. Cody, do you agree that AI could contribute to a rise in this type of fraud?
So I'm very interested in the potential of data and more advanced analytics, including AI, to address fraud. This is not an area that FinReg Lab has studied deeply, but I do think there are ways that we could be potentially leveraging the more complex analytics with comprehensive data to do a better job of catching fraud actors of different types. So I would love to come back to you on the other side of potential research.
Well, consumers could see themselves becoming victims of increasingly sophisticated scams as a result of AI, both due to increasingly accurate deepfakes, more precisely targeted social engineering attacks, and it's not just the consumers that are being targeted. There have been reports of scammers using AI to imitate a consumer's voice in order to trick their bank or credit card servicer into transferring funds or giving away information, what can and should financial institutions be doing to minimize the risk of AI-powered scams targeting them and their customers? And I'd open that up to any member of the panel. Ms.
Now, I'm happy to jump into that, and I think that there's a few things that should happen. First, law enforcement agencies should be taking a lead in terms of understanding the broad nature of the scams that are taking place. Just this past week, NSA, FBI, and CISA put out a very good report on deepfakes and scams, and it's that type of information that can then be circulated amongst financial regulators and the private sector to look at the best ways to combat this. And just like any other technology that's developed, it can be used for fraud, crime, and other scams, but you can also leverage that technology for good. So I think it's critical that financial institutions invest in AI-related technologies to detect fraud and scams. It's also important for financial regulators to have the resources to be able to invest in that type of technology as well. From a surveillance perspective and transaction monitoring perspective, you can use tech to combat. I also think collaboration between public and private sector on this, sharing threats, is really important.
All right.
And-
I like some of those. Yes.
Yeah, if I might add. So I agree that AI is potentially very powerful fraud scamming technology. It's really on the dimension from misinformation to new kinds of fraud. I think that Senator Rounds made some really important, excellent points about we have existing fraud protection laws. We also have the ability to enlist AI in combating fraud, and I think that could be a really powerful tool. The things that I would suggest also focusing on, though, is that when you have the AI on the fraud side and on the regulation side, that is another example of one of these arms races, and where that leads to is somewhat indeterminate. And I think that needs a lot more study. The other is that there could be new kinds of fraud that are falling through the cracks of the existing legal or regulatory system, in part because of some of the AI loophole notion that I mentioned in my testimony, where laws that were developed not thinking of this kind of super impersonation, or are there other new kinds of things, or things that were done by automation rather than by people, are not really covered.
Let me go to a different topic. Because of the way AI learns by studying large sets of data, if there is a bias in the underlying data, then it can become encoded in the AI decision-making process. In financial services, this can exacerbate existing disparities in areas such as mortgage lending, capital allocation, and credit availability, among others. Professor Wellman, how can we work to ensure that AI doesn't stratify or even expand existing disparities in access to financial services?
Yes, and I think as Ms. Cody in her testimony pointed out, it really can cut either way. And what we really need are better tools for interrogating our models to understand what is the basis that they are making decisions on. Are they using factors that we would rather they not use? Again, it's another area where the existing discrimination legal framework may or not be adequate in all senses to capture the kinds of discrimination that could come from AI models.
Yeah, my experience, unfortunately, is that when it can cut either way, it normally cuts against us as a minority community. So how should we think about issues of accountability and oversight when it comes to AI models? Anyone have any ideas on that? Yes.
I'd be happy to answer. Yeah, I mean, what's really important here is making sure to start that the data that you're using to build the models in the first place sufficiently represent full populations. And one of the challenges we've had in terms of access to wealth building opportunities like mortgages is we have 50 million US adults who cannot be credit risk assessed with traditional data and traditional methods. So we've studied cash flow data as a type of financial data from a bank account or a transaction account, and interrogated, is that data enabling lenders to actually credit risk assess populations who otherwise would be excluded? We looked at short-term revolving small dollar lines of credit, but we did find that cash flow data are predictive, and they are more representative of underserved populations and communities. So to start with, making sure that the data that these more complex models or even simple logistic models are using is fully representative is an important place to start. I do think the disparate impact requirement assessment, our fair lending laws, are putting obligations, legal obligations, on interrogating for disparities between different demographic populations. And we did interrogate the extent to which approaches for finding less discriminatory model alternatives using automated techniques and machine learning techniques work. And there we actually did find you can identify models that create less disparities using these more automated and machine learning approaches. And so we're quite encouraged by that. But let me be clear, we were looking at supervised machine learning algorithms, not the types of Gen AI large language models that I think are capturing a lot of our attention right now.
Senator Kennedy of Louisiana is recognized for 5 minutes.
Professor, when a consumer interacts with AI-generated content, let's say as voiced by a robot, do you think the consumer has the right to know that it's talking, he or she is talking to a robot?
If that question is to me, yes, I do. And I think that is really a key area, these new kinds of necessary disclosures where we can try to reduce the incidence of this kind of fraud.
That's a yes. Does anybody disagree with the professor? You agree, both of you?
I generally agree. I would like to know personally.
Okay.
I do also generally agree with that. I do think it depends a little bit on your definition of AI and the particular function or use case we're discussing. But generally, when you're talking the financial services sector,
Professor, do you think the consumer should be able to know not only that the content is generated by AI, but do you think the consumer is entitled to know who owns the robot and therefore the generated content?
Yes, and I think that's part of a more general principle of knowing in any entity that you're interacting with what interest are they representing.
Okay. When a bank loans money, it has a profit motive, does it not?
Yes, sir.
It wants to be paid back. Is that correct?
Yes, sir.
And if the bank is not paid back enough times, the bank goes broke. Am I right?
That is correct.
Okay. Do you think it is possible to generate, through artificial intelligence, an underwriting system that precisely determines who is unlikely to pay back a loan?
I believe that that machine learning models with a lot of data and AI can significantly increase the accuracy by which such decisions could be made.
Can it do that right now?
Lending firms use models right now to predict the best they can, subject to the kinds of factors they're allowed to consider to determine whether a loan will be paid back.
But I'm going to use as the benchmark the current underwriting system, the different approaches that various financial institutions take. You think AI can improve on that in terms of determining precisely who's likely to pay the loan back and who isn't?
It can improve on that in part on the ways that it could potentially take into account much more information than is generally available to systems.
Okay, and let's
today.
suppose that system is developed, and all of you experts agree, yes, this system is more precise in determining who is likely to pay the money back as opposed to someone else. It's better than what we have now. By definition, it's going to have a disparate impact, is it not? I mean, some people are going to get a loan and some aren't, right?
That's right, but I think that we need to make a distinction between...
Okay, can I just finish this thought?
Certainly.
Because I only have a minute. if we all agree on that system, this is a really good system to predict who can pay the money back and who it can't. And we know by definition it's going to have a disparate impact. Some people are going to get a loan. Some people are not going to get a loan. Do you think at that juncture government should step in or has the right to step in and say, no, we don't like the result?
Yes.
Because it didn't include enough people from this area or enough people of this educational level.
I think there are other interests besides accuracy that are legitimate to be considered in the public interest.
If you could answer my question, do you think government at that point should be able to step in and say, no, we do not like the results?
I think that in some circumstances, if the reason for that decision has systematic negative effects in our society, that would be a legitimate interest.
But we all agreed, didn't we, that this system was the best system available?
It was the most accurate, which I don't necessarily think is the same thing as being the best.
So you think, what other factors do you think should be considered other than whether someone's going to pay back the loan?
Notions of fairness in
So you think a loan should be made to someone who's less likely to pay back the loan as opposed to someone who's more likely to pay back the loan on the basis of fairness, and government ought to make that decision?
I think if the processes by which the decisions are made are not fair, those processes should not be allowed.
You want quotas, in other words, right?
No, that's not correct.
It sounds to me like it's correct. I don't know.
I
Mr.
would
Chairman,
just-
can I let this gentleman?
I would just add that under the law, a lender has to look for a less discriminatory alternative when they use a model. But I think the promise of AI here is that FICO and other kind of legacy scoring systems are known to very heavily correlate with protected class characteristics. AI done
Yes,
right.
but this would improve on FICO, and if we
that's
all
right.
agree that it's an improvement on FICO and it still has a result that government doesn't like, should government have the right to step in and say, yeah, it's a better system, but we don't like the results?
No, I think if it's more fair and more accurate, that's an absolute win for society. And I think even under existing tests that we have in the law, AI can be a big improvement on the status quo.
Has expired. Ms. Coide, I'd like to start with you. For some time, a number of us have raised concerns about how big corporations are using people's data. Now companies are using data to train AI and machine learning systems. There's little clarity in where this data comes from, how this data is being used, and to what end. What action should Congress and regulators take to protect people's right to privacy?
I think that's a great question. Everybody knows we don't have a general data protection federal law in the United States, yet we do have in financial services the Gramm-Leach-Bliley Act, but as I mentioned, it is 20 years old. I think starting with understanding where are the data, what are they being used, what type of consumer data are being used by different entities, what are the purposes of the data that are being used. We focus clearly on financial services applications. What are the objectives that we have for the data? And again, inclusion is a really important policy objective I think we all share. And then going back and looking at what does Gramm-Leach-Bliley offer, who's not covered, small businesses, and data privacy protections for small businesses is an area for further exploration with GLEBA. The CFPB is currently writing rules with respect to consumer data sharing under 1033 authority with Dodd-Frank. We still, nevertheless, have important questions around downstream protections when the data are shared with consumer consent, and how do we make sure that there are protections, accuracy protections, ability to correct with downstream flow of data. So I think a holistic look at what are the data privacy laws that we have writ large, but also how are we looking at it very holistically in financial services would be a service to all of us.
Thank you. Professor Wellman, AI surely can increase efficiencies, can reduce cost. Financial service providers certainly have to have access to substantial and expensive resources to acquire the data. Small and regional banks may not be not be able readily to adopt these new technologies, in part to further industry concentration. How will the adoption of AI affect competitiveness in the banking sector?
Yes, thank you for the question. I raised the point about concentration of information, ownership, and access being a new lever and source of power disparities that will exist to a new level that they didn't before. And I think that is something that needs to be looked at and understood, and see in considering in what sectors, in what realms, use of information collected for different reasons may be applied.
Another question for you. Large language models like ChatGPT sometimes behave unpredictably, as you've pointed out, by providing sometimes consumers with unauthorized access to sensitive information or hallucinating, if you will, false information. LLMs could be used to compromise consumers' safe, sensitive data. Despite these risks, financial institutions are using chatbots. Professor Wellman, how do we encourage responsible development of public AI tools while ensuring that consumers and savers are protected from bad actors that could exploit these vulnerabilities?
So I think it ultimately boils down to accountability and ensuring that whoever is deploying these tools is responsible for the behaviors they conduct. I think that there's also ways to help to improve the technology that makes them less susceptible to certain kinds of hallucination. Even if you can't absolutely rule out the possibility of these loopholes, they can be subjected to rigorous inspection, testing, sandbox exercises that could improve the robustness of the technology that all are using.
Thank you. Last question, Ms. Coita. You stated, quote, more complex models exhibit higher predictive performance, smaller disparities across all metrics. However, there are concerns that complex models are less transparent. How should regulators navigate this implied trade-off between fairness and transparency?
Yeah, so to clarify, that reference is specifically to the models that were built such that we could then interrogate questions around explainability and fairness. I think, as I have shared, we independently interrogated machine learning algorithms and the extent to which post hoc, after the fact techniques could actually generate explanations for how those models derive their outcomes. And there we found these techniques were able, some of the techniques, again with human oversight, were able to generate reliable explanations of which features were most important for the model's predictions. Then we separately interrogated questions around fairness, and we found there that more automated techniques produced a range of alternative models that had smaller demographic disparities. So again, compared to more traditional methods of looking for correlations in the data and dropping problematic variables. So we find that to be encouraging in terms of what a machine learning as a form of AI may be able to produce in terms of getting us to more fair and ultimately more inclusive credit underwriting decisions. Back to Mr. Kennedy's or Senator Kennedy's question, I don't think anybody wants people, households, small businesses to be able to access credit that they can't repay, right? Safety and soundness is important for the financial sector, but it's important for people and small businesses too. And so the extent to which machine learning and data can help us find and understand risk within, that's a really important piece in I think the opportunity that we see in front of us with machine learning as a form of AI.
Thank you. Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. Technological innovations and the use of artificial intelligence and machine learning spaces have just emerged all over our nation and in various sectors. For instance, in Alabama, we've seen examples of positive capabilities of AI and how it can help enable effective military operations. I am particularly proud of the work that goes on there in the defense and the intelligence community. The role AI plays in financial services directly impacts individuals and small businesses in my great state of Alabama and across the country each and every day. And while it has received significant attention only in recent weeks in Washington, D.C., many in the financial industry have been using this type of technology for years. Not only have banks and insurers utilized these capabilities of AI in their underwriting practices and risk management, but you have also seen a history of mature AI governance that can be a model for other industries to use. There have been calls from some of my colleagues to what I believe amounts to over-regulation of the industry. I believe as legislators, we should take a more strategic look at this and be very thoughtful about how we approach a governance framework for any type of emerging technology. Being sure that appropriate guardrails are in place that allow for innovation and enable positive use cases while mitigating potential risk. To do so, it's important we continue to have these types of conversations we're having today so that we can learn how AI is helping customers to access financial services so that they may otherwise not be able to access, and to recognize that, like in many spaces, that bad actors find a way to utilize these things in a way that we hope to be able to curtail. So my first question is for you, Mr. Gorfine. How should we properly balance the strong capabilities of AI to help improve fraud detection and cybersecurity while managing the fact that these technologies can and have been used by bad actors?
Yeah, thank you, Senator, for the question. And I think that's absolutely right. I think one of the more promising areas of artificial intelligence is in this RegTech space, regulatory technology. There's incredible potential in terms of market surveillance, trade surveillance, that certainly capital markets regulators are able to deploy. There's also anti-money laundering and other type of financial crime tools and technologies that are being developed that are far better at identifying anomalies, patterns that traditional analytic tools wouldn't be able to use. So I think that there's an opportunity for government. Regulators are able to use this, law enforcement's able to use this, and the private sector is able to use it. The first line of defense will typically be whether it's exchanges or banks that deploy these types of RegTech tools to more effectively and efficiently find bad actors and look for fraudulent or manipulative activities. You know, on the flip side, absolutely, as we've always seen, criminals will use new tools and new technologies to engage in crime. You use, I think, a law enforcement approach. I was noting earlier the NSA, FBI, and CISA putting out, I think, thoughtful guidance on some of their research into deepfakes and scams. And I think it's really important for that information sharing to take place.
Absolutely.
We've done it before, and I think we can continue to do it with this technology.
I'm hopeful that we see more guidance, particularly out of the CFPB for general consumers and alertness on that in particular. My time is kind of winding down, so I want to make this as quick as possible, but I'm very interested in how we can utilize AI to reach underserved communities. So if each of you can just very quickly tell me kind of your top thought on what we need to be thinking about to make sure that we reach those that may not be reached otherwise. Yes, please.
Happy to go first. I think the data is really critical, making sure the data that are being used are actually representative of underserved communities.
Okay.
Happy to follow up.
Absolutely, please. I'd love to work with you on that.
Sure.
I think in the retail banking space, the ability to use models to provide access to capital to underserved communities is tremendous. On the capital market side, I think digital investment advisors that are using these tools to bring down the cost of advisory services that used to cost tens of thousands of dollars and only the wealthiest could afford it. Now retail investors are able to access sound investment advice as well because of these tools.
Okay, thank you.
I second that last point. I think that AI has a tremendously potentially democratizing dimension by making really powerful tools and broad knowledge available to many people if that access can be ensured to be equitable.
Okay, thank you so much. Thank you, Mr. Chairman.
Senator Warner from Virginia is recognized.
Oh, well, thank you, Mr. Chairman. I was hoping that grab Senator Kennedy on the way out, because I think his premise on his question of, well, we've decided this model really worked. Well, whose judgment do we take on that? If, you know, and I'm not going to pick Facebook out as a foil here, but we had Jan LeCun yesterday testifying before the Intel Committee, and Senator Rounds was there, and he went through all the iterations of what they were doing to test out the Llama model before they released it. By the way, letting that large language model into the wild has dramatically changed the economics around all of AI. But do we really want to take that company's testing format and accept that as kind of the standard? I think that is one of the questions we've got to grapple with. You know, Senator Britt, I agree with her as well. You know, we don't want to overdo it, But we also have to recognize, when Senator Rounds and Senator Schumer had the kind of who's who, from the big tech folks to the civil society, all 22 folks raised their hand and said, yes, we need guardrails. Yet what's ironic to me is that most of those, particularly the tech guys in the room, were the very same people who had framed the social media platforms. And Congress's record on doing anything with social media is a big fat zero. So I think we have to be humble, modest enough to realize getting from, yes, we ought to have guardrails, to how we write those in a way that we could actually legislate is going to be a huge challenge. So let me drill down a little bit more. Where I hope we would start is, and again, I caveat this, we had that presentation last week. We still don't even have a general agreement on an AI definition. But where are the areas where AI could have the most immediate, devastating effect today? I would argue that the two domains that completely rely on public trust, that where AI could be hugely manipulative, are faith in our elections, and the tools that were used in 2016 are child's play based upon what deepfakes and other tools could be used on a effort on steroids. And the other is around public trust in our markets. And while we've seen a little bit of disruption, Professor Wellman, I know you've done some work in this space, we've really not seen the catastrophic effects. So maybe I'll keep with public markets because it's easier than some of the First Amendment issues on elections. But try this out. I think the potential negative effects of AI tools on our public markets are so great that we may need to introduce a concept of like overweighting, so that, just as we say, murder is murder, but we're going to have a higher penalty if it's caused by a terrorist, or weapons of war are bad, but we're going to have an extra sanction on chemical weapons versus other traditional weapons. Do we need to think about, do you agree that the tools on AI in terms of undermining trust in public markets and potentially destroying public markets is a unprecedented tool, number one? Number two, and we'll go down the whole list, does that mean we need a new law, or does it mean we've already got laws against market manipulation, we need to either have a lower standard of proof or a higher level of penalty, because the absolute decimating effects of a fully launched AI attack on the markets could be so catastrophic that we've got to think differently. So one, are these greater tools in terms of threats to the public markets? Two, do we need a new law? Or three, do we just need to rethink penalties and or burdens of proof? So whoever wants to go.
Thank you for the question. I couldn't agree more that the fundamental issue here is trust and the potential of undermining the trust. When I talked about market manipulation, any particular incident of market manipulation is just stealing a little, some money. The real danger, of course, is that if it's systemic and parties no longer believe that there's a level playing field and investors are afraid to enter the market, and we lose trust, and our capital markets just would cease to function.
And aren't there and to the question, aren't the AI tools' ability to do that at scale so much greater than a traditional individual market manipulator of even 5 years ago?
I believe that potentially AI can supercharge market manipulation and potentially evade kind of the current regulatory schemes around market manipulation. That's what I would be concerned about, and it needs to be addressed.
Yeah, listen, I think that trust and market integrity are absolutely critical. I do think we have circuit breaker controls. There are model risk controls that are in place, but given the fact that we now are learning what these tools are capable of doing, I think it does mean that what market participants need to do to comply is heightened in terms of, are you taking the right controls, practices, and governance around your models to prevent a market disruption or manipulation?
Ms. Cody?
I concur with all of that.
Well, I would just, my time's about up, but I would just say, for the record, if we all agree there's a bigger threat here, the question of what we do, because I don't think we can simply accept the validation of the vendor without any check that, hey, this system works. And then does that mean you need a new law? Do you need a higher penalty? Do you need a lower burden of proof if you think this tool could be this devastating? Do you want to quickly?
Yeah, I mean, I think the risk we hear is definitely there, and I would yield to the experts on how we think about setting expectations so that there is oversight, sufficient oversight for these kinds of risks.
Well, I hope we think about public elections and public markets, and there might be this collaboration where we could actually put points on the board. Because my fear is, I just don't want to see us repeat what we did with social media, which is a big fat zero.
So I know we're out of time. Broader conversations about setting expectations, even using potentially the frameworks we have in financial services, principles-based expectations on non-financial actors who are using more complex AI techniques, I think is an area for exploration. It's not only good governance expectations, it is also fairness and risks of bias and thinking more holistically about how we set expectations with these more complex models.
Thank you. Thank you, Mr. Chairman.
Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So AI is getting a lot of attention in Washington. The tech giants have come to tell us how to shape new laws that will advance their business models. But laws already exist governing some aspects of AI. Earlier this year, the Consumer Financial Protection Bureau reminded us that, quote, existing legal authorities apply to the use of innovative technologies just as they apply to other practices. In other words, breaking the law with fancy new tools is still breaking the law. So I want to talk about one of those laws today. A biased home appraisal can be a terrible financial blow to a family. One study of mortgage approval algorithms showed that in 2019, lenders were 80% more likely to deny home loans to black applicants than to white applicants with similar financial characteristics. In June, the CFPB proposed a rule that would require mortgage lenders to have quality controls in place that would ensure that the algorithms that appraise home loans are not discriminatory. So, Ms. Coity, you're an expert in consumer protection and financial inclusion. Does CFPB have legal authority to implement such a rule?
Thank you, Senator Warren. I join you completely in the importance of access to home ownership. It is a wealth-building opportunity. And yes, I do agree that the CFPB does have these authorities. You are correct. There's been research by the Urban Institute. Fannie Mae, Freddie Mac have also both recently found home appraisals systemically undervalue homes in majority black neighborhoods. And the CFPB, both under the Fair Housing Act and the Equal Credit Opportunity Act, are able to apply appraisals, are able to cover the appraisals as reflected by federal regulatory guidance, which dates back all the way to 1994.
Okay, so I think what this says is the lender cannot discriminate and then claim AI made me do it.
Absolutely.
The lender remains legally responsible for outcomes that violate the law. Is that right?
That's correct.
Okay. Similarly, the Equal Credit Opportunity Act, which you just referenced, and its current law, says that when lenders decide who gets credit and who doesn't, they can't discriminate on the basis of age, race, sex, national origin, religion, family status, or use of public assistance. And that's true whether they do it face-to-face or they do it through AI. So, Ms. Coity, has the CFPB identified other potential violations of consumer protection laws involving AI?
So again, the consumer protection laws are in place and agnostic on whether or not it's a complex technology that's being used or a human decision. And they do have the authorities to take action around discriminatory behaviors as such.
Okay. So in other words, the Bureau is saying that if big banks like Wells Fargo, that they will be held responsible if they use AI to cut costs and as a result end up misleading consumers who are just trying to resolve a dispute with the bank or ask for advice on some of the most critical financial decisions of their lives. You know, good for the CFPB. There is no AI exception to our consumer protection laws. So this is another example of why the CFPB's work is so essential. Over the past 13 years, the CFPB has returned $17 billion directly to American families that have been cheated by financial institutions, money that otherwise would have stayed in the pockets of those Wall Street executives. I am proud of the work that the CFPB has achieved, and I look forward to working with my colleagues to support their work in the future. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Van Hollen from Maryland is recognized.
Thank you, Mr. Chairman. Thank all of you for your testimony here today. And just focusing on my home state of Maryland for now, we are the home to NIST, which many have talked about as being a test bed for certain AI systems before they're, quote, let out into the wild. So we are very focused on that. And the University of Maryland recently received a $20 million grant to investigate what trust in AI is all about. We're obviously discussing very high-level principles, trust, safety, trying to figure out a way to actually make those concepts more particular through possible legislation down the road. But it is important to begin to define those terms and try to implement those terms. We also have a number of our HBCUs that are involved in this important AI work. Professor Wellman, I wanted to turn to an issue that you raised in your comments about using AI to intentionally manipulate markets. And you indicated that your research has demonstrated the possibility of an AI independently learning to manipulate a financial benchmark given only the objective of seeking profit, right? So as I understand it, you tell the program, we want to maximize profit. You have a sophisticated system. It can go out and essentially accomplish that goal and without necessarily any human intervention. Could you talk a little bit more about that?
Yes, thank you. That's correct. Using a technique called reinforcement learning, basically what the system does is it tries a lot of different actions and it sees what works. And if it will naturally stumble on actions that we would consider manipulative as an effective way to make profits, and we've demonstrated that could be made to work. So that would really. It turns out even if not only did they not instruct it, but even if the developer of the AI did not want to manipulate, having to make sure that they don't accidentally do something that would constitute manipulation would be very hard to do.
Could you talk to a specific, just an example of how a AI system might accomplish that manipulation? So
in benchmark manipulation, that happens when the price of some asset is used to determine the value of something else. And so by putting in orders or making trades that would increase the price, say, of that benchmark, even if you lose money in those trades, you could make money because of something else that's tied to that price. That's an example of a benchmark manipulation, and it's something that's pretty easy for an AI to figure out.
And what you're suggesting, at least I think in your testimony, is that because a lot of our anti-fraud, anti-market manipulation statutes are built on intent, human intent, that if someone simply programmed this to say maximize profit without necessarily wanting it to manipulate prices, there's a question about whether or not that individual who let that system wild would be subject to liability. Is that
my understanding from speaking with my law school colleagues at the University of Michigan is that it's at best unclear what the law would say about that.
Appreciate that. Is that Ms.
Coide.
And if you could bring your experience to bear on answering that question. I mean, there's so many issues with AI, and I appreciate the chairman getting us sort of started in this committee on this, but that is clearly one. Could you talk to your sense of whether the laws need to be updated for that purpose?
So our focus, research, and expertise is more on the retail financial services banking side. So I would yield to my colleague on the market side.
Okay, thank you.
Oh, well, thank you. No, and so I think the way that I look at that is that model risk techniques should identify potential risks. And this is an important risk that the professor is identifying. So proper model building technique would then be to build controls and governance to ensure that that form of manipulation does not occur. It's an interesting question. If someone blindly or willfully blindly tries to avoid building in those controls, that sounds reckless to me. Now, I haven't looked specifically, would a reckless standard satisfy intent? It seems to come very close. So I think that's an important area to identify these types of risks and make sure controls are built. Equally so, the financial market regulators, CFTC, SEC, need to be upgrading the market surveillance tools to be able to look for these new forms of manipulation, because I think that's going to be really important going forward.
Well, I appreciate that, and that's actually why I started my comments by referencing NIST. Whether it's NIST or some other entity, it is important to have, first of all, some set of rules that apply to everybody, and then some capacity to measure whether or not a particular AI system is complying with those rules and preventing the kind of outcomes that we're talking about here. That's just one example. Obviously, it is one in the financial sector. But thank you all for your testimony. Thank you, Mr. Chairman.
Thanks, Senator Van Hollen. Thanks to the three of you. Thanks, Ms. Coy, Professor Wellman, Mr. Gorfine, for joining us today and your insight and your words. For senators who wish to submit questions, for the record, those questions are due 1 week from today, Wednesday, September 27th. The witnesses will have 45 days to respond to any of those questions. Thank you for that. With that, the hearing is adjourned. Thank you.